With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, September 20th, 2024. Going to start off with a really big thank you to the state of Delaware for once again putting us in the top spot. It was the USA Today Community Choice Awards. And we were all able to attend a beautiful event there at Bally's in Dover earlier this week, Tuesday evening, where we received top awards once again. So thank you, Delaware. We really appreciate the love and you giving us your votes for that award. It's really, really awesome. And look, and while I'm talking about that, I've got to give a major, major shout out to our team at BIG. And I've said before, I'd put them against any team in this industry. You know, I had a conversation once with the CEO of Wells Fargo Advisors. We were having some issues, and so I'm touching base, trying to iron a few things out. And we're going through the list, and we get to the end of it. He says, you know, David, we're pretty much aware of some of these inefficiencies you're bringing up to me today. He says, but, you know, you're the only firm that's picked up on it. Nobody else is even aware that this stuff is going on, that we need to improve in these areas. He says, you've really got the best team in the business. I've got to tell you, he's right. And it's just gotten better. I mean, from the folks that have been with us for over a decade to our most newest hires and folks have come on board to the team. I think we've got the best team assembled that we've ever had at the moment, ever. So I think things only get better from here. So big shout out to them because they are awesome and the reason why we do so well. So let's talk about the markets, jump into the numbers. It was a good week. It was a good week. I have to tell you, the market and the Fed, they all surprised me a little bit this week. Let's talk about the numbers here. Dow Jones up 1.6% this week. S&P 500 up 1.3% and hitting a new all-time high. So it broke out of this range, hit a new all-time high, broke out of the downtrend. NASDAQ Composite up 1.5% this week, and the Russell Small Caps up the most, up 2% on the week. Volatility Index drifted a little bit lower, down 2.4%. Long-term bonds also drifted a little bit lower, down 1.5%. We're seeing what's called a re-steepening of the yield curve right now. So it's kind of interesting. Long-term interest rates have been drifting just a little bit higher while short-term interest rates have been coming down. A lot of that's due to the Fed. We'll talk about that. When you take a look at the sectors, really the defensive areas, consumer staples, which is very defensive, down 1% this week. Healthcare, also defensive, down 0.5%. And real estate also looked at as a defensive sector, down 1.1%. Everything else was up and up pretty nicely, anywhere from 2 to 3, almost 4% for energy. So some nice moves to the upside across the boards, pretty wide engagement there as far as the market's concerned. And gold was up 1.4% and silver also up 1.4%. So a few things moving markets this week. First of all, we had some economic data that's actually was a little bit better than expected. We got a little bit better manufacturing number earlier this week. That's been a bit of a surprise as manufacturing's been very weak. We had a really good retail sales number, better than expected retail sales number, showing that the consumer continues just to hang in there. They are not throwing in the towel. They are still spending some money. And of course, the big news of the week was the Federal Reserve cutting interest rates, which we expected they would do this week, but they cut by 50 basis points, as 0.5%. Really big surprise to me. The way this Federal Reserve has been, Jay Powell's character and nature just really lends itself to moving at a quarter point. But remember I told you last week that there's some fishy things going on. There are a few stories that were coming out that kind of sounded like they could be leaks from the Federal Reserve trying to set the stage for a bigger rate cut. Now, look, I got to tell you, I'm not disappointed with it. I thought they should have cut rates in July. I think they're late. I think they should have cut a quarter point in July, and they should have been doing another quarter point here this month. So I thought they were late. With this move, they've caught up to where I think they probably should have been. I'm not sure if it's too late or not. The time will tell. But it was out of character for Jay Powell. Look, some of the inflation data we've gotten, I mean, it's been okay, but it hasn't been so great that you should feel super comfortable to go at 50 base point clip on the rate cuts. So that's a little bit, I don't want to say concerning, but something we want to keep our eyes on, okay? The inflation monster is not fully slain yet, and that could still be an issue moving forward. Powell's favorite word during the press conference was recalibrate, recalibrate, recalibrate. And look, I will say this, they're out of step. I mean, the rates are way too high. We're nowhere near neutral. We're very, very tight right now. Inflation is down in the twos, and we're 5% on the Fed funds. So it is definitely out of step, and we want to kind of get it more in line. I just thought that they would take a more measured and paced approach of concern. Probably they would cause fear in the market. You know, when the market's looking for 0.25 and you cut 0.50, sometimes the market can be afraid that the Fed's seeing something that it's not. Oh boy, are we getting ready to head over a cliff? Is that why they're suddenly being so aggressive? But again, I think that floating this idea through back channels last week, allowing the market to adjust for it, not only did the market adjust for it, the market was expecting it by the time the decision rolled around this week. It was like a 55 or 60% odds of a 50 basis point cut versus a 25. I was kind of thinking we would be in a situation where it would be a lose-lose. 50 basis points, half the market wouldn't like it. It would go down. 25 basis points, half the market wouldn't like it. It would go down. But that's not how it played out. Day one was a little sloppy. Market was up a lot, drifted lower in the close. But yesterday, Thursday, market really ripped higher, and it held a lot of those gains today. Today, things did drift back a little bit. And look, we're still not out of the woods as far as volatility is concerned. There's a few indicators that are suggesting the market's rich here. The S&P oscillator, I talk about that. I subscribe to that. 5 or higher, expect a pullback. At close of business today, it's like 7.5. So that's on the high side. The DeMark indicators, we talk about Tom DeMark and his work. They're showing getting really close to some upside exhaustion. I think we'll probably hit those numbers next week. So as I've mentioned before, October in the presidential election year is usually a pretty ugly month. We can't take that off the table. That still may be how things play out. But whether it does or it doesn't, I think the market has done a few things to set itself up for a strong finish. And look, with some of this better economic data, the market may give us a bit of a move higher here, especially with the Fed in easing mode. So we might see a pretty good run post-election into the end of the year. I don't think we're out of the woods on recession either. Just because the Fed has cut rates doesn't mean anything in that regard. Historically, once they start cutting, things get ugly. The only times they don't are when they cut and we don't get a recession. But the odds of that happening are low. They just are, right? It's almost wishful thinking. Not that it can't happen. It's happened before, but it's almost wishful thinking. And that's not how we're going to play our cards, because I don't think that's prudent. I think we have to play the odds, and the odds are we'll probably slip into a recession. Therefore, we're going to play it like that. We're going to maintain a measured approach. We're going to keep plenty of money in bonds, which are paying good rates of interest. So we can do that, right? They're not hurting us like they have over the 15, 16 years prior where they weren't paying much of anything. Now we can get some yield so we can have some money in bonds. And if the market does slip into 2025, if the economy does slide into a recession, we've got that buffer that we can depend on. And if it doesn't, the buffer's not a dead weight, right? We're still making 5-6% yield, and that's not so bad. I will say one more thing before I wrap up. FedEx had a lousy number. Lousy. Horrific. I think it was down 15% today in trading. That's a concern. Talking about recession, right? That's a concern. Big miss on FedEx. And transports have not been playing ball. There's this old theory, Dow transport theory. What it states is that the transports need to confirm the move of the market. And if the transports don't confirm the move of the market, then it's a false breakout and things may slip back again. Look, some folks say that's old school and doesn't apply anymore. I kind of look at semiconductors these days more than I look at transports. But I'm not saying that rule is out of effect at this point in time. I'm not saying that. I'm still watching it. I think it's still valid until it's not. So again, things I'm being mindful of. So I'm going to wrap up. Between now and next week, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's start your own investment firm and be rock stars in the state of Delaware. Thank you very much. Maybe it is retire a little early. Maybe it is take that big trip. Hey, maybe it's go to Disney with your family. I had a client this week talking all about that, and she's paying the way to go. So, hey, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.